Welcome to TalkTickers. You're here for the inside track on the latest earnings calls, and today we're diving straight into Alphabet's Q1 2025.
That's right. Google, YouTube, Waymo, the whole group.
And it looks like a pretty strong start to the year for them. More than just good, really, showing some serious momentum.
Absolutely. They really kicked off 2025 with some impressive results. Consolidated revenue hit $90.2 billion.
$90.2 billion. Wow. How does that compare?
That's a solid 12% jump year over year. 14% if you look at constant currency.
And the profit picture.
Even better, actually. Net income just soared, up 46% to $34.5 billion.
46%. That's huge.
Yeah, it translates to earnings per share of $2.81, which is a 49% increase. Pretty substantial.
Definitely. And operationally, margins.
Also running strong. Operating income grew 20%, hitting $31 billion. And that pushed their operating margin up to 33.9%.
33.9. Solid. And cash.
Generated $19 billion in free cash flow. And they ended the quarter with like $95 billion in cash and marketable securities. So a very healthy position.
Okay, so big picture looks really positive. Let's dig into the segments a bit. Google services, that's the core, right? Search, YouTube.
Right, the main engine. That division brought in $77.3 billion. Up 10%. And that growth came from, the usual suspects, search and YouTube doing well.
Okay, so search specifically.
Search and other advertising revenues, they also grew 10% to $50.7 billion. They mentioned specific strength in financial services.
Oh, interesting. Like insurance.
Exactly. Insurance and also retail advertising were called out.
Okay. And YouTube ads.
Matched that pace. Okay. Also up 10% to $8.9 billion. Good growth from both direct response and brand advertising campaigns.
So broad strength there. What about the non-ad parts of Google services, subscriptions?
Yeah, that was the real standout within services. Subscriptions, platforms, and devices, that category jumped 19%.
19%. What's driving that?
Mostly YouTube subscriptions, premium and music. That pushed the category to $10.4 billion.
So people are really paying for YouTube. That makes sense. And profitability for services overall.
Very strong. Operating income for Google services jumped 17% to $32.7 billion.
And the margin?
Expanded nicely, up to 42.3%. Really impressive efficiency there.
42.3% margin on the core business. Okay, let's shift to Google Cloud. Always a big focus area. How did it do?
Cloud is definitely still a major growth engine. Revenue was up significantly, 28% year over year.
28%. To what level?
$12.3 billion for the quarter.
And within cloud, what's moving the needle? Is it just general growth or specific areas?
Well, what's interesting is that GCP, the Google Cloud platform itself, actually grew even faster than the overall segment.
Faster than 28%. Why?
Seems to be driven heavily by AI adoption, plus their, core cloud products. And Workspace also did well, higher revenue per seat there.
Okay, so AI is really boosting GCP. And the profitability of cloud. Yeah. That's been a journey.
A big improvement there. Operating income hit $2.2 billion.
$2.2 billion. And the margin.
That's the key part. It basically doubled. Went from 9.4% last year to 17.8% this quarter.
Wow, doubling the margin.
Yeah.
That really shows they're getting leverage.
Yeah.
And probably benefiting from that AI demand you mentioned.
Exactly. Scale and demand are really helping the bottom line in cloud now.
Okay. Now, what about the other bets, the sort of moonshot projects like Waymo?
Right. The longer term plays. That segment brought in $450 million in revenue.
Okay. But still investing heavily, I assume.
Oh, definitely. The segment reported an operating loss of $1.2 billion. So, yeah, significant ongoing investment.
Makes sense for those kinds of bets. Any specifics on Waymo's progress?
They gave some interesting numbers. Weekly paid trips using their autonomous vehicles scaled up massively, reached 25,000.
25,000 paid trips a week. How does that compare?
That's a 5 times increase compared to last year, so rapid scaling.
Where are they operating mostly?
They mentioned expansion in Silicon Valley, and they've also partnered with Uber down in Austin, so pushing into more markets.
Okay, so progress, but still costing a fair bit. Let's pivot to the big topic, AI. It must have been all over the call.
Oh, absolutely. Front and center. Sundar Pichai really emphasized Gemini 2.5.
Their latest big model.
Yeah.
What did he highlight?
Its strengths in reasoning, coding, even scientific discovery. He also mentioned the new Gemini 2.5 Pro and Flash models.
Right, the more specialized ones.
Yeah, and he claimed they're actually outperforming their own internal benchmarks, so pushing the envelope.
And Are developers using these tools?
Apparently, yes. AI Studio and the Gemini API saw user growth of 200%.
200% growth. That's huge developer interest.
It really is. And AI overviews in search, that's now reaching over 1.5 billion users every month.
1.5 billion users interacting with AI in search. Across how many places?
140 countries. So massive global reach already.
They also mentioned an experimental AI mode.
Yeah, apparently it's leading to people typing in longer search queries, suggests a different kind of interaction.
Interesting. And the visual AI stuff, like Lens.
Still growing. Circle to Search is now on 250 million devices, and Lens is doing 5 billion visual searches a month.
5 billion, okay.
Yeah.
So AI is clearly permeating everything. What else stood out? YouTube's anniversary?
Yeah, YouTube turned 20. Quite a milestone.
And still growing. Beyond the ads we talked about.
Definitely. They hit 125 million music and premium subscribers.
125 million paying subscribers.
And get this, over 1 billion monthly podcast users now.
1 billion podcast users on YouTube.
Yeah, and Nielsen data apparently shows YouTube is now the top streaming platform overall in the US by watch time. Just dominant.
King of video, big in audio, massive subscriber base.
Okay.
Now, all this tech needs infrastructure. CapEx.
Capital expenditures were pretty substantial, $17.2 billion just in Q1.
17 billion. Where's that mostly going?
Primarily servers and data centers, building out the backbone for cloud and, of course, all that AI compute.
Makes sense, but that must mean depreciation's going up too.
Exactly. That's a consequence. Depreciation costs are rising as these assets come online, something to watch for margins later.
Okay. So heavy investment. How are they balancing that with shareholder returns, buybacks, dividends?
They're doing both. Returned $17.5 billion to shareholders in Q1 through buybacks and dividends.
17.5 billion back to shareholders.
And they announced a 5% dividend hike plus a new $7 billion share repurchase program.
So signaling confidence and rewarding investors while still spending big on growth.
Yeah.
Okay. Any interesting partnerships mentioned?
A couple, yeah. Roblox is using Google Ad Manager for immersive ads. Could be a sign of things to come in, virtual worlds.
Metaverse ads via Google. Interesting. Anything else?
Toyota used a YouTube creator, Zach King, for a campaign and saw a 25% lift in brand awareness. Shows the power of creators still.
Right. And on the cloud side?
They mentioned over 500 companies showcasing results driven by AI on Google Cloud, and they acquired a company called Wiz to boost cloud security.
Okay. So lots of activity. What about the outlook? What do they guide for the rest of 2025? Any headwinds?
Yeah, they did flag a couple of things for Q2. They expect tougher year-over-year comparisons, especially in financial services ad growth.
Because it was so strong last year.
Presumably. And also potential cloud capacity constraints, which might make cloud revenue growth a bit lumpy quarter to quarter.
So maybe some deployments get pushed out.
Possibly. They expect more capacity to come online later in 2025. Full year CapEx projection is around $75 billion.
Just $75 billion for the year. And the margin pressure from depreciation.
Yes, they noted that. Depreciation was up 31% in Q1, so that will likely pressure margins going forward. Also, headcount growth, especially in AI.
More hiring.
Yep, in AI and other key areas. Plus, higher stock-based compensation expected in Q2 through Q4 will add to expenses.
So costs are rising. How are they managing that?
They emphasized efficiency, said they're monitoring compensation, optimizing infrastructure, trying to manage costs despite the heavy investment.
Okay, so navigating growth and costs. What's the sort of overall investor takeaway from all this?
Well, the Q1 results show really strong execution. There's clear momentum, especially around AI.
And the margin expansion is key.
Definitely, particularly in both services and cloud. That's a big positive in the current environment. Sets them apart from some peers, maybe.
Right. And cloud's growth, driven by AI, makes them look like a stronger challenger to AWS and Azure.
Absolutely. They're positioning themselves very strongly there. Look, there are still macro uncertainties and those rising costs are real.
Sure.
But Alphabet's huge cash pile and diverse businesses give them a buffer. The big investments in AI and cloud, while hitting near-term expenses, really signal their long-term strategy.
And returning cash to shareholders doesn't hurt investor sentiment.
Exactly. The buybacks and dividends add to the positive picture for many investors.
All right. So you've heard the numbers, the AI push, the cloud acceleration, the shareholder returns. Now, for that part of the show, our speculative thought experiment segment. Remember, everyone, this is absolutely not financial advice, just kicking around ideas.
Definitely not advice. But okay, given everything, Alphabet's pouring money into AI infrastructure, right? Huge CapEx, driving cloud growth.
Yep, clearly.
So here's a thought. Maybe look at companies involved in the really specialized networking gear needed for these massive AI data centers. Think advanced switches, optical components, the stuff that handles insane bandwidth with low latency.
Okay, the company's building the AI superhighways inside the data centers. A long position there.
Potentially, because Alphabet and others need that tech to scale their AI. Now, to hedge that, maybe consider a short position in more traditional content delivery networks, CDNs.
Why short the CDNs?
Well, the argument would be that companies like Alphabet, building out their own hyper-optimized internal networks for AI data and model delivery, might rely less on those traditional CDNs, especially those that haven't clearly adapted to AI-specific traffic patterns.
So AI infrastructure build-out boosts the specialized network guys, but maybe squeezes the older CDN models.
That's the idea. Purely speculative, based on the trends we just talked about. Something to chew on, nothing more.
A fascinating angle, looking at the underlying plumbing of the AI revolution. Thanks for that. Okay, that wraps up our deep dive into Alphabet's Q1 2025 earnings. We've covered the key financials, the big AI developments, the outlook.
Hope this gave you a clear picture of the main takeaways. What do you think about that AI strategy? How big an impact will it have?
Lots to consider there.
Indeed. Thanks for tuning in to TalkTickers. Join us next time and we'll break down another key earnings report.
And just one last reminder.
Yeah.
This was all a summary for informational purposes.
Absolutely. Should not be taken as financial advice.